we've got a jam-packed half hour. We're going to look at the value assessment statements, the first cohort that have come out and published. And we're going to look at those through the eyes of the end investor. So we're going to start with a recap and put ourselves firmly in the shoes of the end investor. You know, what is it that value means to them? What is it that they want to know? And then we can see how the first cohort of reports have done in talking to that. So a quick recap, some of you on the call will have worked with us on this, so it will be a recap, but let's just set the scene. So winding the clock back, April 2018 feels like a very long time ago. We were told that the FCA wanted asset managers to do value assessment statements, and they set out their 7 now famous, non-exhaustive, I will say, the list of factors of what firms had to consider. And we read this and we thought, well, actually, if we're going to look at value and we're going to report on value, we have to first ascertain what value is, and who better to ask than the people paying the fees at the end of the day, that is the end consumer. And over the last 18 months, we've now talked to nearly sort of 9,000 fund investors, both advised and non-advised, and talked to them about what value means to them. So summarising, and we can give groups a more detailed recap if you'd like to understand this more, but based on a lot of qualitative and quantitative interviews, we have come up with these 4 main pillars. Some of you will have heard me talk to them before. These are the core component parts of value for an end investor. And you can see here we can start to sort of break it down into various criteria. So competitive charges compared to other funds, we might think of that as comparable rates, low charges, performance compared to cash, interesting, I'm going to talk to that later on in the webinar, but also clarity and transparency and knowing what to expect. So that sort of the brand and the communications and the clarity are very, very important component parts of value, and have largely actually been disregarded in the first cohort of statements that we've seen published. And what we can do is start to weight these and ascertain which ones are the most important. And I've pulled out here the top 5 as rated by end investors, things that really, really matter to them. And the top one there, the returns are better than keeping my money in cash. Gosh, you'd think I might have actually turned my mobile off before starting this. Apologies. So then let's have a think about how value plays out at a brand level. Having done the initial wave of research to find out what it is that the end investor valued, on a quarterly basis now we go to 2,000 fund investors and talk to them at an individual brand level and ascertain what they think about value. And this is the sort of latest sort of results. We've shown the top 10 here. We went to end investors actually by accident, but we scheduled this for the end of March, which was just as markets were crashing. And you'll see in the right-hand column there, this was the sort of ranking when we said to people, okay, which asset managers do you hold funds with? And for the ones you hold funds with, would you please tell us whether they offer you good value, yes or no? This is a very binary, simple question to kick things off. What was really striking from the responses in Q1, so remember this is as markets are falling around people's ears, is we saw a real surge in large global brands, and we saw a particular surge as well in those offering passive funds. So for the first time in the 5 quarters we've been doing this, Vanguard were rated top for sort of in terms of who offered value for asset managers. You can see there Aviva, HSBC still sort of very highly ranked. Interestingly, Lindsell Train fell out for the first time ever since we've been doing this of the top 10, and other sort of more local brands and perhaps sort of smaller brands were equally punished there. What's interesting from sort of what we can pull out sort of when we really dig into the responses that people give, and I think this is an area of value we haven't really had the time yet to consider. Really differs what people value, on a brand by brand basis. So if we look at the customer base of brands like Keynes, Bailey Gifford, Lindsell, Train, these are typically a hobbyist type of investor. They have a broad suite of investment holdings. They can talk more confidently about the investments they have. Some of the major life brands or the retail banking brands, I've cited some there. It equally applies to groups such as HSBC, for example. They'll typically hold fewer funds. They struggle to name the brands that they have. And then when we dig into the confidence and the understanding as well, it's much lower. And I think this is important because when we go on then to talk to customers of these brands about value and what it means to them, it differs. So typically for those less confident customers, the less confident investors, who they will find much more value in brand, in peace of mind, in perceptions of strength, size, solidity, all those things. Whereas for perhaps some of the more hobbyist investors, they're looking at performance net of charges. It's very much a sort of performance story rather than a brand story. So I think it is interesting for groups to consider value in light of who their end customers actually are. Other things we can sort of start to pull out, I've shown a few of the brands here, but it really differs according to if you're asking an advised investor or a DIY investor. And you can see on the sort of above the line here, Lindsell Train, for example, they're much more likely to get a higher value rating with a DIY investor than they are with an advised investor. On the right-hand side of the chart, we can see that Schroders and Merian, for example, are the two brands who are much more likely. I mean, there's a huge difference in the value scores and the value assessments from advised investors than there is from DIY investors. And we can start to sort of unpack that in more detail. But again, it's really interesting to think about who your end customers are and how the way they buy your funds impacts their perceptions of value. I'm going to touch on ESG just a bit here. I saw the stats out this morning. I've got them on a post-it note on my wall here. They were so striking. For the Q1 flows, £385 billion worth of outflows globally from funds, £46 billion of inflows into sustainable funds. So a really sort of compelling and accelerating trend. I think it's really odd that more groups have not included ESG as a factor in their value assessment reports more specifically. And what is telling is when we research this with those same fund investors and we ask them about value, but to consider it through an ESG lens, we can see sort of that the brands fare very differently. So you'll recall that Vanguard was top of the pops in Q1. It's nearly bottom, interestingly, of this table. So people do see ESG as a component part of value. What's equally telling in this slide is the high proportion, those green bars, of people who are going, I simply don't know. I don't know how my provider does when it comes to ESG. And that is applied to some of the larger brands in the UK. It's applied to, we can see that groups such as BlackRock, Schroders, M&G, for example, get a very sort of high ranking of people saying, I simply don't know how they do in terms of ESG. So I think that's something we need to spend more time thinking about in future value assessments. So then diving into a look and the review that we've done of all the value assessments, we focused in on sort of 15 assessments from some of the larger brands out there. And we've assessed them through the lens of that end investor. So very much sort of thinking, well, what have we learned from the research about what people want to know to help them to assess value? And how have groups done in addressing that? And I've just picked out a few excerpts to share with you now. We're going to look at some aspects of performance, Going to touch on comparators, so important to the end investor, charges, clarity, quality of service, ESG, and then the structure of these reports. Some of them, the longest I think I've seen is 455 pages. The shortest is 5 pages. So we're going to sort of look a bit about the varying structures out there that we've seen. So just sort of talking to performance, I mean, I just want to reiterate that performance is, of course, the single most important thing that investors think about when they're computing value. And we've done a bit of work with end investors to ascertain the various weighting and importance to them of those pillars of value. I do actually think it's really telling here, of course, that the main thing for investors is performance. But look at that, service and clarity, so neglected really in this first cohort of value assessment statements, is collectively more important than costs and charges. So I think some food for thought there. But performance, the number one thing that people want to know. Less is less. There's an excerpt here from a particular report. This happened to be a report which was included with the annual reports. And this is at fund level. This is what it says about performance. And if you think about what investors want to know, how is it done? How is it done compared to cash? How is it done compared to peers? There's no specific information here. And I think that is an error. Someone's looking at the value assessment report, not to see a number, I think means there's something missing. I've pulled out an example here from Schroders. I actually think Schroders value assessment statement is one of the best I've seen, but it is disappointing. Look, they've got all that blank space in the performance bit. People are looking at their fund here. At least show them a number, at least show them how this fund did. I think it's missing. The Orbis statements that we've looked at it's an easier job for them. They've got 3 funds they're reporting on, but they do make it very clear here for this particular fund. And I think it's useful. They show the numbers. They show the numbers across various sort of time frames, and they show the net return there. So with this one sort of table, they're dealing with peers, they're dealing with comparators, they're dealing with fees and performance. I think it's quite a useful and succinct way to get that information across. And then here, again from the Schroders report, I do think what's good and being done well by many groups is for the underperforming funds, there is a narrative. And I think, it doesn't have to be much, it doesn't have to be war and peace, but there's 2 things here I like. It's an underperforming fund, or one that they flagged concerns with. There is a simple narrative which makes sense to me and is clear. There is also the actions taken, okay? And I think that actions taken, I'll sort of come to that, is such a key part of the value assessment statements, isn't it? It's why we're doing it. Vanguard are very good in this throughout their report. It's like, how can we do better? How can we improve? What have we learned? I think they're the right questions to be asking. But that narrative there about the fund's performance, I think is good. And it's enough for the value assessment statement. It's succinct. I think it's helpful. Aberdeen Standard, their approach, again, was to sort of review, go into more detail, give some narrative about performance where they've highlighted an issue. And I thought this was quite a helpful way to sort of set it out. They're not going to sort of go through ad infinitum, cutting and pasting, as many groups have done, exactly the same body of text, fund by fund by fund. They've decided to sort of save the narrative for those 3 funds there sort of highlighted where there is a performance issue. And again, some sort of narrative, which is enough, I think, for these value assessment statements. But it is important, and I think with many firms, that narrative was lacking. Now, box of frogs, I'm told that's apparently an expression I must have picked up in Australia. It means something sort of a bit confusing and slightly chaotic. There was very little consistency. Now, in itself, that's not necessarily a bad thing, in how groups chose to evaluate and compare performance. You can see there from all the reports we looked at, an even split between annualized returns and rolling returns. 8% of people didn't even really say anything specific, which I think is problematic in a value assessment statement. Timeframes, again, a huge range. Some do it since inception, some can go right up to 10 years. I was surprised that so many focused in on a 3-year timeframe. To my mind, a 5-year timeframe is probably optimum, but many groups, of course, have decided to report against multiple timeframes, and we pull this out in the report and document which groups have taken which approach. And again, do people report against the objective or the benchmark? The vast majority will report back against the objective, but there's little consistency in how groups have chosen to do this. One thing I think is so interesting is Rathbones is the only group I've seen to date which has used cash as a comparator. And I know this is a conundrum for asset managers, and the argument is, well, that's not what you're trying to do, so why report back against it? But the fact is, if you sort of think back, it's the single biggest thing that end investors want to know. And if you don't tell them, they will go away and get an Excel spreadsheet and work it out anyway. And I think it's just lacking. You know, it doesn't acknowledge that for investors, there's an opportunity cost with their money. The alternative was to leave it in the bank, but they've given it to you. So of course, there is cash being used as a comparator, as a way of assessing their actions. So I didn't quite cheer, that makes me sound really sad, but I was really pleased when I saw this in someone's report. So chapeau, Rathbones. I think that is brave, and it's what people want to know. Okay, moving on to sort of think about charges. We know costs, of course, are important. Possibly not as important as the industry press or as indeed groups would make out, but they're still fundamentally important and a core part of the value assessment that an investor will go through. And we can see from some work we did on fact sheets and disclosure last year that very few people, this was done with a bunch of investors, so existing fund investors, only 23% could work out, you'll see there on the right, from the information they were given, what the all-in costs would be. And I know some fund managers actually who got this wrong. So people are confused about costs, and they want us to pull out the costs and charges for them. There's an excerpt on the left from Columbia Threadneedle's value assessment statement, and I think, you know, hats off to them for disclosure and transparency. I wonder if it's slightly overdone. We've got a lot of columns there. There's the AMC on the very left, admin fees, then the total of that is the OCF, and then sort of the total cost of investments. Possibly slightly over enthusiastic, but I do really like that they've shown the total cost of investing, which includes transaction costs. And I also really, really like that they have shown it, hooray, in pounds and pence for an assumed pound amount invested. So important. That comes through every time we do any research with customers. They want it in pounds and pence too. So I think that is great. Transaction costs. We could talk for hours about transaction costs. Should we show them? Should we not? Are we going to show some transaction costs and our competitors are going to be weasels and show different ones and make themselves look better? And customers want to see all-in fees. Rathbones include them, so I think that's great. Unfortunately, they then cloud the issue by showing UCITS costs, MiFID II costs, and at this stage, I can tell you most investors are lost. And then within the main value assessment statement, there's at least half a page of narrative about the difference between UCITS and MiFID, and I think they get themselves tied up in knots. But showing transaction costs there is super important, I think. I've pulled out in the yellow box something from Elgin's value assessment statement, we introduced a simple all-in fee model so you could see exactly. Note that this fee model does not include transaction costs. And at that point, it's neither simple nor all in. When is a door not a door when it's a jar? So I don't think value assessment statements are the place for riddles. And I applaud the intent there. And it's good to see Elgin making moves towards that. And I do sympathise with the complexity of it. But trust is so low and so lacking out there. And I think by publishing something like this, it simply makes it more confusing. So we have work to do. I saw in Schroeder's value assessment statement, they're moving to an all-in model. And I really, really, really sincerely hope that it's an all-in model. Comparable charges. This is really important to end investors. They want to see both performance and charges against a finite group of relevant peers. So the IA sectors are very broad. They're too broad. If you think about, this is what the sort of consumer research told me, you think about a DIY investor, they might be on Hargreaves, on Fidelity, wherever, they can build a model, a chart, and you can get about 8 lines onto a graph before it just gets too horribly complicated and you can't see it. So that's the sort of size of the peer group that investors are used to navigating, sort of 5, 6, 7, 8 maybe. So these vast sectors are too broad for people, but they do want to know how a particular fund's doing compared to others. And this page on the left from the sort of Vanguard statement, I think shows it visually very clearly. They show it against the Morningstar peer group, and I think this is a very sort of succinct way of conveying a lot of information to end investors, and I thought this page was useful. The Rathbones one, again, this is a bit of a bugbear across all of the reports, is there's an amazing amount of groups who talk about peer groups without citing, you know, what they actually are, or without giving anyone any sort of reference material. So the board of directors concluded the fund's costs represent good value, but they haven't given us the tools that they've used or the insights there. It compares favorably with its peers. Who are the peers? There's the Merriam report there, an excerpt from the Merriam report. For me, the sort of Merriam report is like the jockey of the value assessment statements. It's incredibly short, cheekily short, but it's actually quite plucky, and they kind of get to the point. And in here, they actually tell you what the OCF is, and they tell you what the median OCF is, and that's quite helpful. An excerpt on the right, you can see comparable market rates. This is an example of why, in general, I think the value assessment statements, which are bundled in with the annual reports, don't work. They say so little as to be almost meaningless. Clarity. This is, I think this has been more confusing for groups to walk through that general sort of quality of service module of this. How do we think about it? But we know from our research how important clarity is to the end investors. And I'll say the Hargreaves value assessment statements, not one of my favorite, but gosh, when it came to quality of service, you can see that is a group that understands the end customer. They were the only group who sort of pulled out transparency in the quality of service module, which I thought was really interesting. And it shows, you know, they do understand end investors and what they want to see. This from Artemis was great, I think, talking about the quality of service, and they've pulled out their you know, clarity when it comes to charges. Later in the report, there's something about understanding the clarity of objectives as well, and I thought that was really positive and good to see. But across the board, oh dear, quality of service, and I just sort of highlight again that chart. It's super important to end investors. They want to know what they're paying, and they want to understand what this fund is trying to do. and they want to understand the comms that you send out. There was an awful lot of marking one's own homework in the quality of service parts, and I do not think that these words, we've relied on customer feedback and subjective judgment, cut it when it comes to value assessment statements. Be personal. Well done, James and Nick there, a sort of message to our customers. This is the intro. It actually feels like something you might want to read. And James is there from Schroeder Starts. I've worked at Schroeder's, yada, yada. It's a personal introduction. It makes this much more likely to be read and to be sort of looked through by the end investors. And I think this is a really nice touch. Vanguard do it really successfully as well. So well done, guys, on that. A few sort of closing comments. Structure. The FCA came out ages ago and said, here are 7 things that you should think about, but it's a non-exhaustive list, guys. Here are just some of the things to think about. The industry has taken those 7 things, and most of the value assessment statements have somewhere a table with those 7 headers. There are no additional things that groups have thought about. And also there's so much cutting and pasting. So for things like economies of scale, there are so many really lengthy reports that just cut and paste the same paragraph in every single fund page, and it's a waste of paper above anything else. Artemis here have said, well, we're actually going to focus in 3 categories. They use those 7 things as subcomponent parts. We're going to think about performance, we're going to think about charges, and we're going to think about service. Aberdeen Standard also reported against those 3 things. It makes perfect sense to me. But I would say, guys, why have you only en masse thought about the same 7 things? It's because our brains apparently can only compute with 7 interrelated things. That's why we have 7 seas, 7 wonders of the world, 7 dwarfs. I don't know why this picture I've chosen has 8 of them on it. Doc's there twice. And JB, I think you're on this call, hallelujah, because actually this is the only value assessment statement I've seen where someone's got an 8th pillar. Marvelous, and it's not for me to sort of judge before we've tested it with customers whether this is a good thing or a bad thing, but just great that someone's actually sat down and thought about what value looks like or might mean to their end customers beyond what the FCA has suggested, because the FCA doesn't know your customers. And the same thing for ESG, where's ESG? Such an important point and a topic. I sort of pull out here the procurement department, don't ask me how I know about this, in the Australian government, have a value for money protocol for people purchasing anything from the Australian government, and they include sustainability as one of the 6 bullet points there that they use to think about value. So I'm really surprised. A few mentions, actually Elgin do some quite interesting things where they pull out stewardship and reference that. I think there was a passing reference to it in the early pages of the Schroeder's report, but otherwise largely glaringly absent. So just some sort of closing remarks and how can we help, and then I'll leave you with which value assessment statements I particularly liked. We have a huge and hopefully valuable report looking at best practice, where we have built a bridge between this is what investors want to know, here are the questions they have, here's what the FCA has mandated you should have or suggested you should have as a bare minimum. What have groups done? What does good practice look like? What works, what doesn't work in terms of the structure, the contents, how groups have addressed it, the narrative, etc., etc. For people who buy the report, we're very happy to look at your value assessment statements and make some hopefully constructive comments. We're currently testing with consumers a few statements that we have built based on the insights we have, and that's in the field at the moment, where we're seeing if it makes sense to people, if it addresses the questions they have. And we do go out on a quarterly basis to 2,000 fund investors. They're a hard group to find. But importantly, you know, those fund investors are buying through platforms, or they've got advisors. They're not all just your direct customer base, because your direct book of customers are not reflective, as you well know, of your broader customer base. So I don't think you can just report back on quality of service by talking to your direct book. This is what is in the report. We go through it all, but we also pull out 10 commandments, good practice for the value assessment statements, and the 10 cardinal sins that we find. And there's lots and lots of sort of illustrations in the report, as you'll see, go into some detail. Finally, and I'm 3 minutes over, apologies for that, guys. I sort of am asked about which ones I've seen to date, which are the better ones. I would say unanimously the ones I don't like appear in the annual reports because they tend to say very little. I think they're very lacking in any detail, and they almost assume that no end investor is ever going to find them or read them, and I think that's an odd mindset. I did like Vanguard's value assessment statement. I thought it was personal. It asked throughout, how can we improve? It asked all the right questions. The quality of service module was a bit iffy, lots of marking and homework going on. Schroders and Columbia Threadneedle, I thought, were clear. They'd thought about design, they'd thought about layout, they'd thought about communicating the message. I did think they were better at firm level than individual fund level, where the information was a bit patchy. And also sort of, I call out, I guess, Artemis and ASI, who actually reference the end customer quite a lot, and some innovative things there. And as I've said, Rathbones for having the guts to cite performance against a cash comparator, which I think is important for the end investor. I've cantered through that. As you can probably tell, we've been spending an awful lot of time over the last 18 months thinking about this, articulating with end investors what value means to them, finding out very specifically what they think about your particular brands, and finally creating this report. So do get in touch if you'd like to talk to us or if we can help any more. That's it from me. The children were quiet for 34 minutes. I'm now deeply suspicious. I'm going to go and find out what on earth they are doing. Thank you for listening. I hope it was helpful.